And that's what this chart shows. This is a comparison of the 10 largest companies in the S&P by market or market capitalization versus the other 490, in the bottom 490. And when the line goes down, and this, mind you, is from 1957, when the line goes down, that means the 490 are doing better than the top 10. So over a long period of time, you have really benefited or outperformed by owning the 490 instead of the 10 largest. But note, there are extended periods that when the line goes up, that means the 10 largest companies are doing much better than the 490. And so we're in one of those periods, started around 2013, and we're in 23. We had the 60 to 72 period, which is called there's a tagline for those companies called the Nifty 50. And then we also know, many of us may remember, kind of early 90s to the dot-com bubble in 2000. In the prior two instances, we had multi-decade, I would say, underperformance or weak performance from the largest companies. Yet to be seen. No one knows the future, but these longer trends haven't ended up working so well for the largest companies. Again, 2 data points. If you're a statistician, it is not a very significant sample, but that's what we have to go by.
Lassie, let me just, if you don't mind, let me pause
Sure.
you for a second. So several people actually submitted their questions prior to the webinar, and I believe most of them should be addressed at the end. But this one is perhaps this is a good time to address it. So the question is really an LPR phrase here. So the Magnificent Seven as of today, how much do they remind you about the tech stocks of 2000? I mean, do you see many similarities, or are these really entirely different types of tech companies?
Right. So I see there's a case for that it's dissimilar, but it's also similar. And I'll give you both. The dot-com bubble had lots and lots of tech companies go up. Tech company, I mean, the most famous is Pets.com. Had barely any revenues, was unprofitable, went up, crashed. Actually, a lot of this was similar to what we had in 2001 when you had GameStop and all these unprofitable companies rallying, and those have come down, 80, 90%. But I wouldn't be dismissive, because you had in 2000, let's look at Microsoft. Microsoft, after the 2000 peak, it didn't go back. It took 17 years for you to get back up to the 2000 peak for Microsoft.
Wow.
The other poster child is Cisco Systems. It's a legitimate company, still around, one of the largest suppliers of communications equipment. Cisco System, has yet, 23 years later, has yet to surpass the peak, because they got up to such a high valuation, or became expensive. So I would say to that question, Alex, there are shades of both. I mean, there is some craziness that is not there, because these are pretty robust, seven large companies. But don't forget, there were large companies in 2000 that really didn't do well in the ensuing decade and a half. In Cisco's case, 2+ decades. Yeah,
that makes a lot of sense. Kind of confirms my thinking too. Thanks, Elsie.
Yeah, I mean, it's never history. You hear the cliche: history doesn't repeat, but it rhymes. So that's where you kind of try to bring your experience with prior cycles of saying, where it might be different and where it's not different. Yeah. This next slide just shows you touches on what Alex said about recency bias, right? This is the performance of the Magnificent Seven relative to the S&P 500. I mean, last year, these 7 stocks gave you, were 60% better than the 500 stock index, the S&P 500. And we're all human. We have a stronger memory, and a reliance on the most recent data points, and that we extrapolate these trends, and then more and more people go into just buying these 7, and that leads to these kind of becoming more expensive, and at some point the music does stop. We just don't know when that is. The the final point would be the concept of expensive, right? The red line is the Magnificent Seven. This actually is a chart that shows it's called the Mega Cap 8. This includes Netflix in there as well, so it doesn't make much of a difference. But it is, as you can tell, it's so much more expensive at 28. Basically, this is how much you're paying for its earnings, versus the other 493 companies, which is in line with the long-term average. And the S&P, the blue line, is slightly elevated, but not by any means. And so if we are in a new economic recovery, because last year, growth and earnings weren't very robust. Earnings were essentially flat in the S&P 500. If earnings are recovering, we're in an upcycle. I could make the case that the 493 companies and the stuff outside the Magnificent Seven are pretty, reasonable. They're not expensive. They're, in line with history, and with earnings growing, you could make the case that they're attractive. So that's that on the Magnificent Seven. The other exciting event we have is the election year. And most, if not all, the narrative that I hear and read makes it sound like the election years are somehow these amazing years. They only go up. And this table, it's a good representation of that argument. This is from Bank of America Merrill Lynch. This goes back to 1928. 83% of the election years have been up years. And not only that, wow, the markets are up 11%. That sounds pretty darn good. It almost makes you feel like these election years are somehow exceptionally better than non-election years. But what the data shows is that actually that's not the case. Election years don't really make much of a difference to long-term returns. And here's a even better chart. The darker blue line is the non-election year average. The election year is actually the lighter blue line. And what this shows is that, at election years actually can, at various points, give you much worse performance than non-election years. So that the first premise is election years are not exceptionally better than non-election years. Non-election year averages are better. Now, this is a 18-month window that you're looking at to give I think, a full picture of the election cycle. The ultimate endpoint, the gap is not as wide, but in the middle, it's quite wide, the performance gap. And the thinking here is that in election years, markets don't like the uncertainty leading into the primaries, because we don't know who the two candidates are. And then once that is done, then they kind of get into a normal groove and start moving higher. Arguably this year it could be different, right? We essentially know who the candidates are going to be, and so perhaps I could make the case you do not need to worry about this uncertainty. We kind of know the two, and we don't need to have a sell off into the primaries, which is what the election average shows. Here's an equally good chart. The message for me would be parties have not mattered to returns over very long periods. Doesn't matter who's in power. Stocks have adjusted to the economic environment. I mean, there's like recessions. There's even, I guess it starts just after the Depression, but there are certainly deep recessions. There are, the stagflationary 1970s. And, again, goes to the point I'm trying to make, like elections, I think, hit us emotionally, but they don't really impact longer term returns. And the real kicker is this, by the way, is a log chart. So these points are, 10x higher. So from this 10 million to this end, this is a chart to the middle of last year. So end of June 2023. The dot here, the last point is 19 million. And so if you had invested $1,000 when FDR was in power, so that, mind you, that was, what is that? That's 90 years ago. Maybe less relevant for all of us on this call, but, if you have children, grandchildren, it is relevant, right? This is the power of compounding and the resiliency of the US economy and stocks. I mean, think about that. $1,000 worth 19 million today. So again, just to drive home the point, elections, yeah, okay, probably gives us some asset reflux, but haven't really mattered over a longer period of time. Closing thoughts, over and above what I said about the other two is, I guess I had the same stuff that Alex kind of talked about. We hadn't really compared notes, but interest rates and CPI are both higher, particularly in the last kind of 2 months. CPI has come in higher than expected. That's primarily because growth has come in better than expected. That is an okay situation. I mean, if growth is higher, there's more demand, you should expect CPI to be higher. So that's one point I would say. If growth is indeed better, then earnings growth should broaden beyond just the Magnificent Seven. And so maybe there's a case that both earnings and the performance broadens into more of the 500 stocks in the S&P 500. And I'm going to touch very quickly on the last two bullet points, which is, they're clear. You're going to realize, particularly the large companies in the S&P 500, they borrow in fixed rates, generally kind of 3 to 5 to 10 years. So they have not felt the effects of rising interest rates. Interest rates have gone up quite substantially, but they will feel the effects in the coming years as they need to refinance those bonds. And so at the margin, as rates stay higher, the companies with more debt ought to feel more pressure or headwind because more of their cash flows will have to go to debt servicing as they refinance their debt. So it argues for, skewing towards perhaps higher quality companies. And the last point is obvious. Alex has already touched on it. So those are my thoughts we've got about, I guess, I'll hand it over to Alex, but hopefully if you have any questions from what I just said or anything beyond, please put it into the chat, the Q&A, and or the chat, and we'll be looking forward to discussing. Alex, over to you.
Thanks so much. This is very helpful. Actually, I learned quite a bit. What the phrase that came to mind, what is it? This time is different. Those are some of the most dangerous words. That's what kind of came to mind when you were, talking. So in terms of the summary, in terms of our top, again, investment ideas at this time, and hopefully, again, this will be practical to you. So again, and I know I'm repeating myself, this is a good time to rebalance your portfolio. Again, there's no excuses at this point because every so often you hear it, well, look, let's say in 2020 when the markets were down, in 2022 the markets were down, and you wanted for your portfolio to fully recover. Well, chances are there's a strong possibility that already happened, and essentially now you would be dealing with gains. Now, what I've been actually discussing in some of my client meetings, if you happen to have some of the stocks that Asi was referring to, well, by any means, the idea is not to just sell them all. I mean, that's what we would essentially never do, but you need to have specific targets for those positions, because as much as they can go up by 100%, 150%, they can go down just as rapidly. So if you have any of those positions, and let's say it represents 15% of the total portfolio, which is not unrealistic actually for certain companies, we'll make sure it's comfortable for you and make sure you have a specific target in terms of how much of it you want to keep. And if it's lower than that, let's say it's 5%, which is usually the case for us when we manage, individual stock portfolios, perhaps this would be a good time to trim the position. Now, as again, Asi was saying, perhaps the growth will, continue throughout the year. Doesn't necessarily mean that you should be selling, your stocks and buying bonds. Again, that's one of the options, though. Consider rebalancing into other growth-oriented stocks that are outside of the tech or consumer discretionary sectors. Plenty of different options. Unfortunately, we cannot discuss specifics in this public webinar, but there are lots of options. They're growth oriented. There are funds too, if that's how you want to implement the strategy. Again, the different choices. Now, over the past, I'm going to say couple of years, or at least a year and a half, many high quality value stocks or dividend payers, they've been, I would say, underappreciated by the markets. I mean, no one or not that many people are really paying attention to them, but they are, strong growers. They're not going to, appreciate in value by double digits necessarily, by double digit percentages each year, but they make dividend payments. 3 to 4% is very common. And one of the questions I get, and I tend to discuss it again in client meetings, you don't always have to rebalance into bonds, because the problem is, even if you get 5% at this point, there's not going to be essentially any growth in terms of your portfolio if you move too much into bonds. With value stocks or more defensive stocks, you still, chances are you'll have some, and at the same time, again, you're going to be generating some income for yourself. International stocks, I touched on that, and we've been, very consistent about it over the past, 2 or 3 quarters, actually. In our opinion, there was some value post Ukraine invasion. So we actually added some into our portfolios earlier in 2022, but since then we actually 2023, I'm sorry, but since then we actually sold most of the allocations, and we're now underweight in international stocks. One of the ideas that actually Asi shared with me, and it makes sense, but when someone kind of tells you that, realize that many large cap stocks, and if you have a lot of them in your portfolio, and specifically technology stocks, in some cases, most of their earnings, or more than 50%, they already come outside of the US. So you already have that international exposure by simply owning those stocks in your portfolio. Again, large cap multinationals. So if you ever decide to add more to the international allocation, essentially what you're doing, you're trying to overweight it. So that can be somewhat questionable. Mid and small cap stocks, again, even though they had a mini rally at the end of last year, we're currently neutral on those types of securities. And there are 2 ways of looking at it. Again, they tend to be more interest rate sensitive, so then they tend to perform better when interest rates decline, and vice versa. And again, at this point, we believe that interest rates will stay higher for longer. On the other hand, many of the companies in this category, they are domestically oriented, and they tend to benefit again when the U.S. economy in this case continues to expand. So we're keeping them at neutral targets. And again, I know I'm repeating myself, and I'm doing that on purpose. There is no excuse for lack of preparation. You need to review your portfolio. You need to rebalance it. You need to be prepared for potential market volatility. One thing I trained myself to do over the past number of years, anytime the markets go up, I become more and more concerned, because I understand that eventually something is going to happen. And again, it tends to be quite rapid. Anytime the markets go down, we tend to get a bit more excited about it. But again, preparation is key. And for those of you who are perhaps, again, getting closer to your retirement years, already in retirement, there's so many options that are paying, decent interest rates at this point. So there's, again, no excuse for you not to do that. And with that, let's get to questions. Again, please type your questions in the chat box, and we will try to address them. We have, how much time do we have? Yeah, we have 10 minutes or so. So while you're doing that, there were a few of them that were submitted to us prior to the webinar. There are short questions, actually, which is great. So here's the first one. Will the market crash this year? Minasi, what are your thoughts on the market crash this year? Do you anticipate it given what we've been discussing today?
And I don't think, couple of things. There is, if you go back and look at many of the crashes, I don't think very many people anticipated or projected it. So, as fiduciaries, we're always cognizant, and that's why we keep banging away on like being diversified, because that's one of the ways to protect against a crash. But overall, I have seen an improving in market outlook or economic outlook. So that is generally not when a crash might occur, but something to always keep in mind. I would say a low probability outcome.
Well, I'm with you on that, and again, I'm trying to stay away from any kind of speculations like global pandemic #2 or some kind of geopolitical event. I mean, because those things can, of course.
How do we do that? I mean, we just don't have that edge.
Yeah.
No one does really. That's the hard.
I agree. Yep. So the other one, again, it's the short one. So good investments today? Question mark. And again, I understand as part of this webinar, we cannot talk about specifics. But what are your thoughts, in terms of generally speaking, what are some of the good ideas to consider today?
What I have seen, and I touched on this, is that the economy is stronger than expected. Right? That's why we thought we were going to have to cut rates more. There were fewer cuts anticipated. If that is indeed the case, then what I said earlier, the earnings should broaden out into more companies, and then the performance should broaden out. And so the performance of the S&P, for example, should come from the other 493 companies that have done basically nothing. I mean, these are not small companies, right? You got J&J, Pfizer, JP Morgan, all of these companies are in there, and they've done nothing over the last 12 months, well, price-wise. So that would be my kind of thought process.
Well, I'm with you on that, and that's in some sense what I was referring to earlier when I was talking about their growth-oriented investments out there, or on the core side, outside of technology. So here's one of the questions from the chat box, actually. Thoughts on AI hype? Question mark. What do you think, Asi? I mean, I have a couple of comments, but please.
Yeah, I mean, it seems the problem is we appear to be moving on just kind of current quarter and next few quarters, maybe 1 year's kind of outlook, and companies we're running the risk of extrapolating this trend. I mean, maybe this is something all new, but it's never, you're already seeing you're getting overweight into these tech companies that have, this is probably the underpinning of the Magnificent Seven. So you're already, if you own the S&P 500, you're getting the exposure more than you would have at any point. So you already, have a good amount. I'm no technologist, but the way stocks seem to be reacting, going up, let's say 50% in 6 weeks, that seems somewhat excessive without mentioning names.
Fair enough. I mean, again, one of the things I remember reading about in terms of technology and how it relates to investments, the public in general tends to overestimate the impact in the short run, and then underestimate it in the long run.
Yeah.
So that's, again, I mean, my personal thoughts, not so much financial, is that AI is a big deal, and it will, do a lot of good, hopefully good things for us as a society. But in terms of the investment case, I happen to agree with you, Asi. There seems to be a little too much of it, over the past 12 months or so.
Yeah.
So yes, if anyone has any other questions, please ask. We have 2 more. Actually, here's one. Well, perhaps this one is for me. How much bonds should I have in my portfolio? Again, I paraphrased this question a little bit. So one thing I'll say in terms of bonds, again, we think of them as a protection mechanism. And this is something for you to have if you're thinking about or you're expecting to draw from your portfolio. At Capital Squared, we actually have a method to figure out how much you need to have, and usually we start with 7 years of your projected cash needs. So 7 years happens to be the average business cycle in the United States. So to say this differently, to give you a specific example, if you retire in the year such as 2020, in March of 2020, and the markets are down by 31% in 17 calendar days, we want you to be in a position when for at least 7 years, you're not required to take or to sell any of your stocks, and you would essentially live off your bond allocation. So that's how much. Now, one thing we absolutely try to stay away from, because it just doesn't make sense, is when people say, well, someone is older, someone is 75, maybe even 85 years old, and now just by default they have to invest more in bonds. That is just not true. I mean, I happen to have many clients in their 70s and even in their 80s. They live off their Social Security, in some cases pension income, and they actually don't have to have that much in bonds compared to young retirees that have, let's say, 30 years ahead of them. There needs to be a lot of protection in place because they're essentially going to live off their portfolio, well, for the rest of their life. So it's a really good question, but the answer to it is very specific to your situation. I don't know if you have anything to add, Asi.
Very specific, right? And one of the things we've talked about, inflation coming in higher, bonds will not maintain purchasing power if inflation stays up for an extended period, like a decade-long period. It'll eat into your purchasing power, so you need to have a portion allocated to maintain purchasing power. And certainly stocks have done that over multiple time periods.
That's right. Well, last question. I don't know, maybe you can give us a quick answer, Asi, where it's almost one. Impact on markets post-election. And I know you touched on that already, but any closing thoughts on that?
I mean, no, it's, what this shows is, there was enough evidence there to suggest that election years don't really matter, and nor does the party. Then I will end it by saying, this time should be no different. Certainly not something, we'd be able to predict. There's probably going to be a lot more impact on markets based on the trajectory of the economy, interest rates, inflation, etc., that are independent of which of the 79 or 80 something year old person possibly occupies the White House come early next year.
That sounds good. As we have a question.
I saw Jason's one, right? So I'll read Jason's question. It says, is investing in Chinese stocks, ADRs, I think is what you meant to say, not a good idea in the short term? So as Alex knows, I lived in Asia for 12 years, and I've spent my 25 years on Wall Street looking at international markets. So an area, it could be, but I don't think I or anyone else really have an edge in predicting what the Chinese Communist Party does, right? So the markets have gone up recently, Chinese markets, because they came and said, hey, no, you can't short stocks. You can't sell stocks. The latest thing is like at the close of the day. These are not fundamental factors that impact returns. So without, I don't want to have specific ideas, but this is not something I feel like I have a certain edge with, because it's such a politicized environment. I'll tell Alex, I have a couple of notes on my website written on just what I think China may need to make it a longer term investment. It could be a short term trade. I can't know for certain. but the longer term issues that China faces will not be tackled by kind of shifting the deck chairs by saying no shorting stocks or forcing local fund managers to buy stocks.